Silicon Valley Bank is in big trouble. They are the 15th largest bank in the United States in terms of assets. They sold off $21 billion in bond portfolio for a huge loss to shore up their balance sheet. The market is really worried. The stock is down 54% today. Here's what you need to know. They announced they completed a $21 billion fire sale, never a good sign, of part of the bond portfolio. And they took a $1.8 billion hit on that sale, which is equivalent to more than they generated in net income in 2021. So terrible loss. Now they've announced that they're going to sell $2.3 billion in shares to cover the bond loss. And then the stock crashed because they're scrambling now to shore up liquidity. Selling shares to cover up losses is a huge red flag. And it's been a terrible week for banking because just yesterday, Silvergate Bank, the crypto bank, said they were winding down operations due to many of the same issues that Silicon Valley Bank is facing, which we'll get to in a second. But how is Silicon Valley Bank's liquidity position doing? So according to the company, they have $180 billion in available liquidity to cover the $169 billion in deposits. So not too bad. But dilution is a big problem because, and this is why the stock is tanking, they want to issue $2.3 billion in new shares. That would be about equivalent to a third of the company today's market cap. So huge dilution. And the stock was already down 47% year over year before today's sell-off. So why are they selling off bonds at such a huge loss? The bank is facing two huge problems. The first is interest rates. They were positioned horribly just before interest rates increased. The company's $21 billion bond portfolio had a yield of 1.79 and a duration of 3.6 years. Compare that to today's 3-year treasury yield of 4.71%. So as interest rates rose over last year, the value of that bond portfolio fell dramatically, and the bank had a choice: ride out that 3-year duration of its bonds with a yield far below the current treasury rate, or sell at a loss and reposition the portfolio to maximize yield. Basically, Silicon Valley Bank had to decide how quickly it thought rates would decrease. And clearly, they don't think rates are coming down anytime soon. The other problem with this bank is deposits. See, it's highly popular for tech companies. And because the tech market is not doing well, that means fewer deposits for this bank. And the restricted IPO and capital markets mean that VC-backed tech companies have less money to deposit in the bank. Moody's cut the company's credit rating and downgraded the credit outlook to negative. And the stock, I don't know. I don't think it's going to do too well here. I think it's in for a very bumpy ride, maybe just as bad as Silvergate Bank, who had to cease operations. Make sure to hit that follow button for more insights like this.